Right now, we are getting initial jobless claims, which is the key data that we get after what we got with Challenger. And they actually come in less than expected. They were expected to come in at 220,000. They came in at 191,000. It is down from what we saw last week, which was at 216,000. Now, for continuing claims, you also see a slight decline. So the people who actually were receiving unemployment benefits ticks lower to 1.939 million from 1.96 million. I know it's like parsing hairs. At the same time, in the right direction. This would indicate that the economy is not necessarily falling off the cliff. Bloomberg's Enda Curran joins us with more. Enda, what do we see here?
Well, it was a holiday-shortened week, Lisa, worth bearing in mind. But I think it's interesting to your point that the continuing claims also dipped a little bit. I mean, you can have the volatility in the headline number, but a lot of people have been arguing that the ongoing increase in the continuing claims suggests a weakening labour market. Nonetheless, the headline figures, taken with the Challenger data earlier on this morning, suggesting that the pace of layoffs has maybe slowed, perhaps suggests maybe the jobs market isn't as bad as thought, or perhaps is even stabilising. But really, Lisa, the bigger picture, though, we have to remember here, even without the official data, of course, is that we've had the ADP, we've had those warnings from the Beige Book, and of course we have rolling headlines from companies that at the very least the labour market is softening. The question now is just how weak it is, and of course until we get a good run of official data, it's very hard to make that judgment.
When you look at markets and how they're responding to this, it's kind of, as you would expect, a mixed picture. On one hand, it does seem like the Fed can cut rates come next week. At the same time, the degree to which they are able to cut rates going forward in question. You could see this. S&P futures now almost flat. NASDAQ futures down now 0.1%. Russell 2000 down 0.3%. The Y is in the bond space. 2s, 10s, and 30s. Yields higher. Price down across the board. Up 3 basis points at the front end. 3.51%. 10-year yields, similar type of move. It does seem like when you bleed this through the currency space, this is actually going to be a stronger dollar, at least for the moment, pausing some of the weakness that we have been seeing. And it does seem like this does put the Fed in a position maybe to cut next week. But after that, a lot of questions of how far they can go.
Well, that is a big question, Lisa, as you say. The markets have clearly decided the Fed will cut next week. We had some strong dovish signals towards the start of the blackout period, in particular the head of New York Fed, John Williams, of course, suggesting that perhaps there is enough there to get the Fed over the line for a rate cut. We don't know that. We know it's going to be somewhat of a close call. But to your point, whatever comes out of that decision next week, and especially if they do cut, clearly the indications will be that it's going to be a complicated story heading into next year. We know that inflation remains well above the target. We get PCE tomorrow. That will give us some indication as to where PCE is headed. But when you consider the backdrop of a weakening labour market, but we don't know by how much it's weakening, inflation still above target, but we don't quite yet know what direction it is headed. It's going to take a few more months to get a final handle on the tariff story. There's a lot up in the air right now. So even if the Fed do cut next week, early next year already looks quite complicated.